Everyone is out here chasing the next can't miss stock like it's the new iPhone on release day. But I only buy when the price actually makes sense. Right now I have 3 great companies, 2 of which I own, 1 I owned in the past and sold it too soon. And I plan to buy more, but only when the price I want to buy them at is below the value I like them at. So when people ask, what stocks are you buying right now? I always smile and say the same thing, depends on price. Because even a great company, a world-class, dominant, amazing business can become a terrible investment if I pay the wrong price. This is exactly why I don't chase hype. I chase value. Today, I'm going to walk you through these 3 stocks, but only at the right price. We're going to evaluate them in our stock analyzer tool. I'm going to break down the story behind each company, the valuation metrics I rely on, and the price point that turns them into I am buying. Because remember, investing isn't about what you buy. It's about what you pay relative to what you're getting. And even more important in this video, I'm giving you the tools and principles that you will not hear anywhere else on YouTube. So that next time you analyze a stock, you're going to have an edge over 99.9% of investors out there just by embracing this methodology. Now remember, guys, I own 2 of these stocks. Never buy a stock that I own. We're here to teach a process and for you guys to learn how to evaluate companies on your own. First stock, Target. Target stock has taken quite a hit this year, following nearly 35% year to date, as inflation has pushed shoppers towards competitors like Walmart and Amazon for essentials and cheaper alternatives. But long term, I believe there's still potential if you're willing to be patient. Target is investing $5 billion next year to improve stores, digital shopping, and product quality, all aimed at winning customers back. With a strong dividend, for those who love dividends, a cheaper valuation than its peers, and a track record of bouncing back, the company has potential to regain its footing if its new strategy pays off. Side note, people are talking about how Cours has turned itself around. Guys, if Cours can turn itself around, surely Target can. Because I never hear people on TikTok, women on TikTok and Instagram saying, I got to get to Coles. But they all talk about getting to Target. And the husbands have these memes and these videos where they go, I have to hold my wife's hand at Target to make sure she doesn't buy stuff. Now remember, we're here to look at the numbers. The stock is currently $86 a share, which means nothing if we don't understand what's behind that. This is a $39 billion company with a $77 billion enterprise value. This difference of $38 billion is essentially their debt. Sounds like a lot, but how much of that is leases for their stores? They generated $2.95 billion in free cash flow last year, which is lower than its 5-year average of 3.3. So that's something to be concerned about. Current PE is 10. Current price of free cash flow is 13. That's cheap. Now, they're paying this dividend. I hate this. I hate this dividend. Guys, I own the stock and I hate the dividend. Why? Why do I want 5.3%? Guys, do me a favor. Go buy your shares back. Take that $2 billion and buy every share you can and hope it stays at 85 or lower. Because if you spend the next 10 years buying back shares, you have massively increased the value of our company. That's what's key. Guys, remember, there are 5 things we can do with free cash flow. We can pay down debt, pay a dividend, buy back shares, invest in yourself with expansion, or invest with acquisitions. Okay, guys, the one I hate the most, the one I want done last, is paying a dividend. If all those other 4 things don't make sense, you pay a dividend. I'm quite sure buying back shares is smarter if the company is undervalued. That's what's important. Another thing, their 5-year return on invested capital is high, 14.25%. For those of you who don't know what this metric means, this is a sign of a good company. The market average is like 9 or 10%. Can they get a good return on the money they invest into the business? If you can make 15% of the money you invest in the business, keep doing it. You'll compound your profit for a very long time. That's the theory behind that. Now remember, if you're new to this and it feels overwhelming, guys, I've been there. We've all been there. I'm here to simplify this as much as possible. So I want you to do me a favor. All these metrics matter. They're the things I look at. I have a cheat sheet for you. I made specifically for free. That way the people who watch our videos can understand these things more. And when they apply it to their own investing, they can also have the questions and answers they need to ask. So if you're interested in this key metrics PDF, it's absolutely free download. Click the link below. It'll be emailed to you very quickly. This is why I teach on YouTube. I'm one of the only people out there teaching true fundamental analysis. It's really important that fundamentals as well as the emotional side is handled in order to successfully invest. And in a couple of minutes, I'm going to go through Target on our stock analyzer to tell you what I think it's worth. But let's go to the 8 pillars first. Okay. A lot of check marks, a few X's. I'm not worried about the debt because like we said before, a lot of it is retail leases. But this cash flow decline sucks. Even though net income is up, the cash flow is down $3.5 billion. I want to go look at that. Have they increased their capital expenditures over the last few years? So I look at this going, okay, their cash from operations is down. So they need to turn, this is part of the turnaround they're talking about. All right, let's see what the analysts think about the company. So they do have a dip in profit per share from last year's $8.79 going to $7.48 and then rebounding back and growing to $10 a share. Now, let's put it this way, guys. If Target's a premium business and you apply 20 times earnings to this, that means in 5 years, it would be a $200 stock. If the analysts are right, that's not bad. Now for revenue growth, decline, slight gain, and back to basically inflation growth. All right, fine. Not a grower, but it's hopefully a shower for us. Now, we now enter the point where we take the story and we have the numbers, we put them together. I always tell people, do your stock analyzer very quickly, very early in the process. Don't waste your time on a company that when you make your assumptions, it's too far away from the price. Move on to another company. This is why I do stock analyzer pretty much. I look at the analyst estimates, my key metrics, and I immediately go right into stock analyzer, put in reasonable assumptions. So let's look at the last time I did Target. I did a 10-year analysis. Now, guys, revenue growth. I did 2, 3.5, and 5% revenue growth for the next 10 years. Profit margin. I did 3, 4, and 5%. Same with free cash flow. Looks pretty reasonable. It's a little bit lower than their 5 and 10-year profit margin, lower than their 10-year free cash flow in the middle assumption. Okay, nothing egregious, nothing insane. I'm good with it. Now, what's the PE I would apply 10 years from now? Now, in this example, I put 14, 17, and 20. I was doing that to hedge a little bit, but I do that I'm actually going to put 17, 20, and 23. Guys, Target does a good job. I've talked to women about this. They do a good job of making it easy to shop there, online, pickups, and women love going there. It would take a lot for that to change. Does Amazon do great? Absolutely. And Amazon has definitely taken away from Target's business over the years. But women still like going, I still like going to the stores. I still like sometimes being out and about saying, let me go stop in there and pick something up. If I look at Amazon and it's not coming until, even if it's the same day, I'm like, oh, let me go out. I don't think all shopping is going away. Is it changing? Absolutely. Are the weaker ones going away? Yes. I don't think Target's one of the weaker ones. That might be a personal bias. And finally, my desired return, I put in 9%. Guys, that's purely to find intrinsic value. I would not buy Target at a 9% return. And by the way, this includes that dividend. So whether they pay the dividend or not, it's still 9%. That's how the model works. I really encourage you to make sure that you sit there and realize that when you're buying a company, you want to make sure you're getting a return higher than what the market does. This 9 or 10% doesn't work in terms of buying it for that price. We hit the analyze button. The stock's currently at 86. This is why I'm interested. We have a low price of 106, high price of 270, middle price of 175. So if my low assumptions are correct, I'm still going to make a 12% return discounted cash flow model on my worst assumptions. The juice is worth the squeeze to me. Now, most investors lose money because they're trying to pick the next big hot winner, next NVIDIA. The best investors do the opposite. They eliminate the losers first. That's what we're doing here when we analyze a stock. And the first way to look at it to eliminate a loser is overvaluation. That's the best way. Because even a great company, if you pay too high a price, it's not going to be good. Munger and Buffett say that when you buy a great company, what might appear to be a high price isn't necessarily a high price. What they're saying is they have a lot of potential to keep compounding on themselves. Doesn't mean that if a company's great, you just pay whatever price. People always miss that. Now remember, when it comes to these titles on this video, it's about teaching a process. I want to grab you in to sit there and realize there are 3 stocks that I want to teach you about to teach you a process. Second stock, another stock I own, Adobe. Now, Adobe is a company that I think is awesome. One of the things I love about it, look at this. Free cash flow, way higher than net income. 9.6 billion last year in free cash flow, 7 billion net income, 7.5 billion in free cash flow over the last 5 years on average, 5.5 billion in net income. That's awesome. Now, Adobe stock has fallen 27% this year because investors are worried about new, cheaper AI tools that do some of the same things that Adobe does, like editing photos and creating designs. People are also unsure if Adobe can make enough money from its new AI features and keep charging high prices. But the company still has a strong business. It is deeply used by big companies, and it's hard to switch away from once you start using it. If Adobe keeps growing in areas like AI, which they are doing, and digital marketing, this drop could be a chance for patient investors to get in at a better price. And if Adobe can turn its powerful new AI tools into must-have features for businesses and creators, it could open up a whole new wave of growth that pushes profits and the stock price higher over time. I talked about this free cash flow. Guys, look at this also. Gross margin of 90%. What's gross margin? It means every extra dollar they sell, 90 cents of it, 90% of it goes to the bottom line before overhead and income taxes. That's huge, guys. Microsoft is like 67%. Apple is like 45%. I'm going off the top of my head. The point is, this is insanely high. Very little acquisitions in the last 5 years, 2.8 billion total. But look at these revenue growth rates. 10.5% a year for the last 3 years, 13.5% in the last 5, 17.5% in the last 10. And look at this return on capital. 22% over the last 5 years on average, 30% last year. 14 times free cash flow, 19 times earnings. This has to be paid attention to. And look, guys, at our community stock rating. We have 160 community members who have voted on this as a buy rating with an intrinsic value of 456. This is loved by our community. Before you think, well, it's because they listen to me. No, there are other companies in there where I go, hey, everybody likes it. I don't. It happens all the time. This is what I love about this community stock rating that we put in. I think one person has it a strong sell. That's kind of funny. More power to them. 8 pillars. So guys, the 5-year PE is the only X because of how much lower it is than the 5-year price of free cash flow. Everything else is a check mark. High returns on capital, buying back shares. I love their buying back shares at 14 times free cash flow. Free cash flow growth, net income growth, revenue growth. I mean, everything's great. Very little debt. They can pay off their debt in 1 year of free cash flow. That's incredible. So now here are the analysts and what they believe. $21 a share this year, growing to $34 a share in the next 5 years. 12%, 12.5%, 6.5%, 9.5%, 9% earnings growth. And the stock goes lower, guys, the company's going to probably buy back more shares, and this will go up even faster. Because as they buy back shares, they're splitting up the earnings per share and the free cash flow on less shares. This doesn't even factor in free cash flow. It's just earnings per share. Revenue growth, high single digits. 10.5%, 9.5%, 9, 8, 8, 7.5%. All right, nothing to write home about. But when you have 80%, 90% gross margin, when you add that revenue, it really drives the bottom line. That's how they're able to grow their earnings per share so much. So here we are, stock analyzer tool, to sit there and figure out what is the price to pay for Adobe. 10-year analysis. First thing, revenue growth. I did 4, 7, and 10%. They were high single digits according to analysts. I put in 7. Profit margin, ignore, because it's not the important one. Free cash flow is what matters. I put 38, 40, and 42. And I want to make note. They did 41% last year. And with that gross margin of 90%, this could become 45% in 5 or 6 years, 7 years. I don't know when it becomes, if they keep growing their revenue 7 to 10% a year. So I think I'm being conservative here. Now, what's the right PE and price of free cash flow for this company? I put in 18, 21, and 24. Guys, look at these returns on capital just getting better. You would sit there and say start at 15 to 16 and go higher for great companies, lower for bad ones. This is obviously a great company. Great balance sheet, great margins, great returns on capital. Relatively sticky. I don't believe that AI will drive. Whenever I hear people say AI is going to eliminate a business, I go, really? Doubt it. Because look at AI right now. Their free cash flow is up. Their revenue is up in the last year. And AI has been going gangbusters for 2 years now. A lot of steep learning curve in the first 2 years in AI. Listen, my wife and I, we use ChatGPT to make modifications, but if we ever need real work done on images, we go to somebody, an actual editor, to sit there and put it in. Now, I'm sure ChatGPT will get a lot better, but just yesterday, my wife was sitting there. My stepson bought a new house, and they wanted to edit this kitchen, and they were looking at this island, and she kept saying, turn the island 90 degrees. It wouldn't turn. Nothing was turning. Again, it's early on, so I'm not trying to take a crap on AI, but the point is we would need Adobe to do that. And I do think Adobe is going to make their AI better. And finally, our 9% return, hit the analyze button, boom. Free cash flow, low price of $380, high price of $820, middle price of $560. Guys, a lot of potential here. It's not on my watch list anymore, but I'm going to add it at 300. In fact, I might sell some puts on this. Let me go to the options chain real quick. So what I'm doing here, guys, is I have cash sitting in my account, making 3.75 or 4%. What I do is I sell puts on companies to buy companies I want at lower prices, and I get a much higher return than that 4% on my cash. So I'm being paid a high return to buy a company I want at a lower price. So for example, if I go to December 26th, the day after Christmas, and I want to buy Adobe at $300 a share. I go to puts, $300 a share. Somebody's going to pay me $9.87 per share for that. Guess what? That's a 38% return on my money. If it goes below 300, I pay the person 300, but I still got my 987. So I basically paid $290. If it's above 300, I keep the 987 absolutely free. I don't get the stock. Now, what's the risk here? There are risks. It goes to 250. But if I was going to buy it at 300 anyhow, I got paid $10 to buy it at 300. You got to take yourself out of that emotion. Now, we have a course coming up soon where we explain this as well as covered calls on how to make money on the stocks you own and how to make extra money on the cash you have. So if you're interested in that, click the link below. Sign up for our wait lists, because last time we did a class on this one, we had 30 people and we maxed out. This one, I think we might extend to 30 again. So make sure you're up there. Make sure you get the notification, because the people who sign up first for the notification will get first dibs on it. Now, the last stock, Meta. Guys, if you remember Meta, back at the end of 2022, it was considered dead. It fell to $88 a share. I started buying it at like $150 all the way down. I actually got lucky and bought on the very low of the day on November 4th, 2022 at $88 a share. But my intelligence there was met by my stupidity when it went up to $195 a share, and I said, it went up too fast. I'm going to sell it, wait for it to go back down. It never went back down. Stupidity. Take the blame on that one all day. This is the last stock on my list of 33 stocks that I want to own forever. It has fallen 18% recently, which has me interested. Look at this. In the last 1 month, it's down 17%. There are no guarantees that I buy it, but I want to find the price that I would buy it using our stock analyzer tool. That way, if Meta continues to drop, and if we had a bear market, Meta will drop hard. I want to be ready. Meta is spending a ton of money, up to $72 billion on AI and new data centers, which has made investors worry about profits in the short term. On top of that, a one-time tax hit made earnings look worse than they really are, adding more pressure to the stock. But long-term, Meta still has a lot going for it. Its main business, online ads, is growing extremely fast with a lot of potential overseas. And it's just now starting to make money on WhatsApp and Threads. You know what's funny? We made fun of Threads for a while. I actually scroll through Threads is good because Instagram will put a thread up and I'll click on it and I find myself scrolling on Threads. I think they did a pretty good job of doing that. I look at it from Instagram. It's funny. My wife signed up for Threads yesterday by accident and she goes, I'm going to delete it. I'm like, don't delete it. If you delete Threads, you delete Instagram, which is, I get it, kind of scammy. But at the end of the day, I get why they did that. So if you delete Threads, I believe that was the way it was originally. So I told her, do not delete Threads. In addition to all this, the AI that they're building could make apps even smarter, ads way more effective, and open the door to new ways to make money. If all that plays out, today's worries might look small in a few years. So let's take a look at these metrics. One of the biggest companies out there, $1.6 trillion market cap. The fact that I say that and I look at that going, oh, that's small. That just tells you what kind of market we're in. Very little debt because the enterprise value is essentially the same. growing returns on capital, 82% gross margin, very consistent 30% bottom line margin. And guys, keep in mind, they still lose $12 billion a year on the metaverse. So they generated $45 billion in free cash flow after losing $12 billion on the metaverse. Now, our community members have it as a hold with an average intrinsic value of 731. Now, keep in mind, guys, it's at 625 now. These are only for 6 months at a time. So if you're in our community, go in there and update your meta vote if you've already voted on them, because we keep the votes for 6 months and then they start to fall off after 6 months. You have to go in there and revote again, because obviously things change after a while. Now, let's look at the 8 pillars here. 6 checks, 2 X's. All the check marks are the fundamentals. The X's are valuation. Now, keep in mind, Meta has a lot of potential for growth. 40 times earnings and free cash flow is a lot. But hypothetically, if God came down and said, hey, you know what? They're going to double their free cash flow every year for the next 10 years. This is super cheap. The other thing is that Metaverse is making no money. So if you add 12 billion to this, you go from 40 to about 30. Still expensive, but they're not making as much money as they could overseas on the average user. I think they still have countries where areas like continents where they make 1/10, 10% per user that they make on us in the US. That's incredible. Let's go look at what analysts think. $28 a share this year, going to $39, call it 40 in the next 4 years. So pretty good growth, double digit. Revenue growth, $200 billion, growing to $354 billion. Big time revenue growth. I'm actually surprised that with 80% gross margin and this kind of growth rate in revenue, that analysts don't have a much higher earnings per share growth. They should, but we'll see. So let's run the stock analyzer tool. Let's take a look at this. I'm going to pull up Meta to put the story and the numbers together. Here's what I got, guys. I have a 10-year analysis. I did 6, 9, and 12% revenue growth, which is lower than analysts. Profit margin, I did 30, 34, and 38. I did the same thing for free cash flow, because in the last 10 years, it was very close. Last 5 years, pretty close. Last year, a lot different because of this big capital expenditure movement. What's the PE and price of free cash flow 10 years from now? Premium company, increasing returns on capital. They have half the world using their products every single month. 20, 23, and 26. And again, my 9% return. Look, guys, the truth is that most people are going to lose money with stocks because they don't have a plan. They buy the wrong companies, or, and this is what's more common, they buy the right companies at the wrong price because of hype. They sell it completely the wrong time because of fear. I used to do the exact same thing for years, and it really felt like the market was rigged to take my money. That was until I learned how to invest the right way. This is exactly why we built Everything Money, to help regular people like you stop guessing and start investing with real confidence. You're going to get our stock analyzer, our tools, our courses that teach you step by step. You're finally going to see the stock market through the lens of success, not fear, through the lens of an investor, not a speculator. Try it for 7 days. You'll see. This isn't gambling. It's common sense. I hit the analyze button. The stock's currently at 626. Guys, I have a low price of 510, high price of 1250, middle price of 800. Do you see how stupid I was for selling at 195? Yes, please come ridicule me because I deserve it. Now, at the start of this year, I put together my own version of the Magnificent Seven. And no, mine doesn't need hype to perform. Click the video on your screen to see the 7 stocks I chose and how they stack up against the market's actual Magnificent Seven. And let's just say, the results are a lot more interesting than you'd think. Thank you for your time.